Welcome to Capital Allocation Lab. Our mission here is really to provide calm, clear lessons that improve your long-term investing judgment. We're tackling quite a bit today, looking at a century of stock market history. The goal, to turn that dense record into, well, a practical policy map for you. Subscribe and like to support more educational episodes.
Yeah, absolutely. We're diving into the patterns in a century of stock market history specifically. And this isn't just, history for history's sake. It's about building a framework, a disciplined one that helps you actually use these lessons when deciding where to put capital. We really have to start with the record itself. I mean, before you jump to opinions, you just got to understand the basics, how things actually work. History shows us pretty clearly how prices, earnings, and dividends tend to move together, even through massive shifts. And knowing that history, that's really the only reliable way to judge if the market today looks attractive or maybe a bit dangerous.
Exactly. And that background, it lets us ask those really simple but powerful questions Graham focused on, like what's really priced in right now? And crucially, how does the yield on stocks stack up against, say, bonds? If we stop treating stocks like lottery tickets and view them as these long duration assets, claims on future cash flows, then today's price and especially the earnings yield, that becomes paramount.
That's it. I often think about it like flying a plane. You've got your controls right, your airspeed. That's kind of like valuation, how fast you're moving relative to, well, perceived value. Altitude is your long-run earnings power, the underlying quality. And the weather, that's the tricky part. Sentiment, liquidity, all that turbulence. You absolutely need a disciplined, objective instrument panel in that cockpit, especially when things get choppy.
I like that cockpit analogy, but isn't sentiment, the weather, isn't that what grabs everyone's attention first? How do you actually force yourself to look at the altitude and airspeed when the market weather is, screaming at you?
Well, you have to recognize that the market moves in layers. You got to separate them out. There's the deep underlying current, the long secular backdrop, real productivity, technology trends.
Right, the big picture stuff. And then layered on top, you have the shorter cyclical waves, the usual expansions, recessions, all those inventory cycles.
Exactly. And then the most volatile layer, the speculative one, that's where multiples, the PE ratios, just spread out or compress like crazy around the actual fundamentals.
Yeah, and the history really hammers home that common mistake, doesn't it? People see a strong cyclical upswing and they think, this proves the long trend has no limits.
That's the trap. Graham's advice, and it's timeless, is always, always separate trend from mood, and keep that yardstick handy valuation versus bond yields. Keep it front and center. And to really feel the power of that mood, that sentiment, we need to look at those three distinct eras Graham identified, from 1900 to 1970, because they show the psychological impact over long stretches.
Okay, so era one, that was what, 1900 to 1924, the early industrial phase. Pretty modest returns, lots of choppiness. Investors seem to overreact quite a bit to just normal ups and downs. The annual price gain was only around 3%. It basically taught people to be jumpy, right?
Yeah.
Fearful and impatient.
Precisely. Then came the really devastating period, era two, running from 1925 through 1949. You had the roaring 20s euphoria, then the absolute catastrophe of the crash, followed by just a long, painful, irregular grind upwards. The annualized price gain, a tiny 1.5%, the big lesson there. A fantastic story, a dazzling narrative. It can just evaporate.
Yeah.
And rebuilding, that takes way, way longer than the collapse itself.
And then the contrast, era 3, 1949 through 1968, the so-called golden age, this massive bull market, the Dow just exploded more than sixfold. We're talking 11% annualized price return, plus, another 3.5% or so in dividends. Huge numbers.
Huge. And those kinds of generational returns, they seduced people. They started thinking that was normal. It would just keep going.
But even inside that monster bull market, the discipline point comes back, right? Because sharp drawdowns still happen.
Oh, absolutely. Think about the 1968 to 1970 drop. That wiped out something like 36, 37% from the averages.
Wow, yeah. That's a serious hit, especially if you thought stocks only went up. And the source mentioned this happened as business fundamentals were actually weakening too.
Yes, exactly. And here's a key point. Markets often recover price-wise faster than the underlying businesses actually heal. That gap between the price bouncing back and the earnings really catching up, that's where discipline matters. It tells you whether to hold tight or maybe selectively deploy capital based on valuation, not just panic or, relief rallies.
Okay, let's make that concrete. You mentioned wholesale re-ratings. Let's use those two snapshots from the history. 1949, pessimism was high. The market was cheap, right? Selling at roughly 6.3 times earnings and throwing off a dividend yield over 7%. Pretty attractive on paper.
Very attractive. Now, jump forward just over a decade to 1961. Moods flipped completely. Optimism is rampant, and the PE multiple, it's ballooned to almost 22.9 times earnings. So the dividend yield naturally got squeezed down to only 3%. And this was happening while AAA bond yields were actually climbing. That massive shift in what people were willing to pay, like 3 times more for the same dollar of earnings.
Yeah.
That's precisely why Graham's core lens is so vital.
Right, which brings us squarely back to the earnings yield, EP, compared to the bond yield. You called it the quiet governor.
It really is.
Yeah.
Because when that EP compresses relative to bonds, the market is basically telling you your fundamental margin of safety is shrinking. It's a much better gauge than just staring at a PE ratio on its own, because it anchors equity value against the real alternative, the cost of capital shown by bonds.
Okay, so let's operationalize that. How does someone listening actually compute this and use it? Walk us through the steps. Step 1. Get a reasonable earnings number. Could be trailing, could be normalized, just be consistent, right?
Yeah.
Then compute the EP, that's just earnings divided by price, flip the PE, and express it as a percentage.
Yep, step 2. Compare that percentage, your EP, to a high-grade bond yield. The AAA corporate yield is a good proxy, a solid benchmark.
Okay, and step 3 is interpretation. This is key. If your EP is lower than the bond yield, the source material argues stocks look fully valued, maybe even expensive. But if EP is comfortably above the bond yield, that yield gap is signaling that equities look relatively attractive.
And this is super important. This isn't about timing the market day to day. Forget trying to trade headlines with this. Think of it as a policy gauge. It helps guide your overall equity weight, right?
Right.
How strict you need to be with position sizes. And critically, how much patience you should probably exercise before committing fresh capital.
You mentioned the dividend yield compression earlier between 49 and 61. Historically, 5-7% yields weren't crazy. But post-war, things changed structurally. Payout ratios dropped, buybacks became a thing, multiples climbed.
Exactly. And that structural shift means we have to look at EP, the underlying earnings power, not just the dividend check. Today's low dividend yields often mask decent earnings. But here's the kicker. When valuations are rich, buybacks can actually destroy value. The company's paying a premium for its own shares. So the yield gap framework, it helps you, maybe as an operator or just an investor, judge if those buybacks even make economic sense at the current price.
Okay, so we've absorbed the history, the valuation lens. Let's try to build that practical framework for planning ahead.
Right. So for long-run nominal returns, think about 3 basic building blocks. 1, real growth in earnings. 2, inflation. And 3, the speculative bit, the change in the multiple. You put reasonable, maybe conservative estimates for those together, you should probably land somewhere around a 6% nominal long-run baseline. That's your planning number, the reality, not the hope,
And the real wild card in any given decade is always that multiple change, expansion, or contraction. It swamps the other factors sometimes, which is why you mentioned that cross-check, the 10-year earnings lens, CAPE style.
Oh, yeah.
For listeners maybe not tracking CAPE daily, why is that decade view helpful compared to just, say, last year's PE?
Well, because a single year's earnings can be really noisy, right? Affected by a boom or a bust. The 10-year view, that CAPE approach, it smooths out those cyclical distortions. And history is pretty clear. When price versus that decade average real earnings gets well above, say, 20, the odds suggest the next decade's returns will likely be pretty disappointing. Again, use it to set expectations, maybe just your savings rate, not for timing trades.
Okay, perfect. Let's assemble the toolkit for the defensive investor. Specific actions.
Okay, tool number 1, calculate that EP. If it's below your high-grade bond yield benchmark, treat equities as fully valued. That means dialing up patience, maybe caution.
Tool 2, keep an eye on the dividend yield versus the bond yield. That spread is your immediate cash cushion. When bonds yield way more, that cushion is thin.
Tool 3, diversify properly. And that means beyond just different company names. Think different cash flow drivers, different sectors, different geographies, real economic diversification.
Tool 4, rebalance mechanically.
Yeah.
I know, it's tough. It feels wrong when markets are screaming up or down, but having preset rules is the only way to systematically take chips off the table or add exposure without letting emotion rule.
And tool 5, a big one. Avoid leverage, especially when that yield gap is working against you. Borrowing just magnifies the risk when valuations are already a headwind.
Now, for operator managers, the CEOs, CFOs running businesses, the tools look a bit different, but the logic's the same, right?
Absolutely. First, CapEx discipline. Capital should only go where the expected incremental return on invested capital clearly beats your risk-adjusted cost of capital through an entire cycle, not just at the peak. And second, share repurchases. They're great when the stock's cheap, genuinely undervalued. They're value destructive when it's expensive. So managers really need to tie that buyback pace to a disciplined yield gap and intrinsic value assessment. Don't just buy shares back because you have cash. Buy them back when it makes economic sense.
Thinking back to that 1964 example from the source, market felt unstoppable, but the advice was simple. Default to caution. Don't add leverage. Trim positions back to your target policy weight. Set those guardrails before the storm hits, basically.
Let's run through a quick workshop scenario. How does this gauge actually work in practice? Scenario A, headwind. Let's say the index PE is 24x. Okay, that means the EP is 1 divided by 24, which is about 4.17%. Now, if high-grade AAA bonds are yielding 5.5%, the bond yield is actually higher than the earnings yield by roughly 1.33 percentage points.
Okay, so the gauge is flashing caution. The implication is pretty immediate, isn't it? You need to reduce your equity aggressiveness. The policy signal is clear. Maybe favor quality, defensive cash flows, and let any automatic rebalancing trims go towards your bond allocation.
Exactly. Now flip it. Scenario B, tailwind. Let's say the index PE is much lower, maybe 12.5x. That gives you a nice, robust EP of 8%, 1 divided by 12.5. And let's say bonds are yielding only 4%. Now, the yield gap is strongly in favor of equities by 4 full percentage points.
Right. So in this scenario, if your equity weight has drifted below your target because you were cautious before, you now have a clear policy signal, a green light, to rebalance up, to perhaps lean into those durable quality businesses you've identified.
Perfect. So let's just quickly list the key mistakes to avoid. Rapid fire. 1. Confusing a good company with a good stock at today's price. Valuation matters. 2. Letting market drift dictate your risk exposure instead of your own deliberate policy. 3. Borrowing money to hold stocks or other risk assets when that yield gap gauge is signaling danger. Just don't do it.
So bringing it all home for you, the listener, what can you do this month? Here's a concrete action plan.
Okay, number 1, write it down. Your specific policy bands for asset allocation and your rebalancing triggers. Get them on paper.
Number 2, compute it. Figure out the EP for your main market index versus a relevant bond yield. Track that spread, maybe monthly, see how it's moving.
Number 3, map your liquidity needs. What cash do you absolutely need for the next 12, maybe 24 months? Set that aside. Make it untouchable for market adventures.
And number 4, score your holdings. Not on price momentum, but on cash flow durability and balance sheet strength. Know what you own, fundamentally. So the map really is durable, isn't it? History first. Always check valuation versus yields. Stay humble about forecasts, and be disciplined in your policy.
That's the core message. And remember the simple rule. When everyone's euphoric, check the yield gap. When everyone's panicking, check your company's cash flows and your preset allocation bands.
Thanks for joining.
If you found this useful, like the episode and subscribe. It really helps us keep these lessons free. This is Capital Allocation Lab.